Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I will be taking you through how to account for exchange differences on monetary items, what we call forex gains or losses. Now, to look at the requirement and the details. It says that show how the above transaction will be accounted for at initial measurement or initial recognition and on subsequent measurement. So two things to look at: one and two. Initial measurement, subsequent measurement. Now, on 1st April 20x8, Winco, with the dollar as its functional currency, and it's important you note that it has the dollar as its functional currency, buys goods from an overseas supplier who uses the euro as its functional currency. Goods worth 200,000 euros were shipped and the payment is due in 2 months later on 31st May X8 or 2008. So look at it. This is the initial recognition date, and this is the subsequent date, subsequent measurement date. Take note of that. Now, what we also need to look at is the exchange rate between the two currencies. Now, on the 1st of April, which is the date of the transaction, we have 0.85 euro to $1. And what it tells you is that the euro is of more value relative to the dollar. So if a transaction value is quoted in euros and you have to convert to dollars, it means you need more of the dollar. So when you translate, you should get more of the dollar. So it means that you cannot multiply. You have to divide the quoted euro value divided by the exchange rate to give you more of the dollar. Now, let me just take you through a simple process of accounting for the foreign gains. So I'll have a date. I'll have date here. Then I'll have the euro, which is the foreign currency. I'll have the rate of exchange, and I'll have the dollar equivalent, which is the functional currency. So a very simple table. Now I'll say that on the 1st of April 2008, the goods purchased, remember, once the goods are purchased, it becomes a payable. It was 200,000 euros. And what it also means is that because we know the exchange rate, which is 0.85, to get more of the dollar, like I said, it will be 200,000 times divided by 0.85, and that gives us 235,294.1. So rounding up to the nearest thousand. Now, what it means is that we are applying the principles of translation and retranslation, because the principle says that for monetary items, we translate on the date of transaction using the spot rate, and the spot rate on the date of transaction is 0.85. Then subsequent measurement, we translate using the closing rate or the rate prevailing on the date of settlement. So So I'll leave a line in between these two dates, and I'll bring the date of settlement from the question, which is 31st May. 31st May. So that is 2 months. So I'll say 31st May here, 2008. And the amount to be paid will be 200, the full amount. So they will pay 200,000, which is the full amount. And we take the rate on that date. So the spot rate on that date is given as 0.82. So we use that to translate. So 0.82. Now, if we multiply 200 times, divided by, so 200,000 divided by 0.82, that should give us 243,902. Now we need to compare the two values on the date of transaction and also the date of settlement. Now you realize that this is a payable, it's a liability. So if the exchange rate shows that there is going to be more value to pay, then we say that there is a forex loss. There's a forex loss on the transaction, and that forex loss will be 243,902 minus 235,294, and that is 8,608. And look at it, we need to increase the value to have this closing figure, which is the settlement date. And because there's an increase, we say there is a loss. So the double entry will be to debit profit or loss, the amount, which is 8,608, and you credit the payment, or in terms of the amount that will be paid. So, but if you want to start with the total payable, then it will be the liability. To be the liability that was settled. So the liability 8,608 would increase the value, and this we have. So that when the payment was made, all we needed to do was to debit the payable. We debit the payable 8. This will be the total amount paid, which will be 243,902, and we'll credit cash or bank the same amount, 243,902. So this will be how we will account for this transaction. So we are looking at monetary item. We translate and retranslate. We translate, retranslate. Exchange differences arising will be reported in P&L. That's what the standard says, which is IAS 21. That's what the standard says. I hope this helps you in your preparation for the exam. Please subscribe to this channel to receive updates on new videos.